Hello and welcome to your Monday Futures Market Outlook for October 4th, 2010. This is Patrick Ceresna. For those of you that have not had an opportunity to try out eMiniSource.com, 30-day complimentary memberships are available on the site. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and when we plot an 80-week moving average on there, it does a very good job to depict the bull and bear market cycles that the markets have gone through. If you look at the average duration between one of these signals, in many cases is not only more than a year, but can be even 3, 4, 5 years between each signal. And the fact that we bullishly crossed above this at the beginning of the year and have actually held above that 80-week moving average continues to support the idea that there might be some more bullish follow through on the market, even towards the 1300, 1350 area on the S&P. The reason that we've actually maintained our bearish bias is up until now, and especially during that entire summer consolidation, we could not rule out the possibility that the entire rally up until from the 2009 low to up to the high at the beginning of the year was not just a retracement of a bear market, like a bear market rally that was popping up. Really at this stage though, with us now having gone through about 5 months of consolidation and subsequently the market strengthening, it's becoming more and more evident that the likely outcome here is that we have a bottom that comes in around this 1000 level, and we have a year-end rally that does make that push toward the 1300 level. Now again, we're not at this stage officially making that confirmation that we are in a bullish mode, but so long as during the next wave of selling, the bulls really contain all of the sell cycle and really support it, and then subsequently create positive price action follow through on the upside, then at that stage we probably would be looking for a year-end rally that lasts again, a minimum up towards the 1200 area, but targeting even as high as the 1300 area into next year. When we take a closer look at the S&P 500 using the E-mini futures contract, we more or less have now finished what we call a measured move higher up toward this 1145, 1150 area, where we've now spent the better part of almost 2 weeks bouncing off that overhead resistance level. Now, the big question that we're trying to determine, we're right now obviously in this significant trade range, but are we going to have this as an ascending triangle pattern that's consolidating before another upside breakout? Or do we first have to still go through a full profit-taking cycle to the downside? We're trying to determine that at this stage, and really technically it's hard for us to make a very definitive stance that one will happen over the other. The fact that we've consolidated this long sideways actually has already dispersed much of the overbought state of the market, and therefore anything that technically breaks above that 1145.50 area, especially if given by a catalyst, whether it's an earnings announcement or some other type of a thing that drives a new move, we could find ourselves up at the 1170, 1180 area within days. But in the same regards, anything that technically breaks down this sideways consolidation zones, particularly below the 1130 area, immediately opens the window for a retracement. Now, we don't necessarily think that that will be a full retracement, but we think that if it does retrace, we would see a move maybe even as deep as the 1090 level. But realistically, we could see major supports coming in around the 1100 to 1120 area on any waves of selling. And if the bulls can actually contain any of the sell cycles to those areas, it would actually still be bullish for the market, as that they would use that profit-taking cycle to begin the next significant leg higher. The only way that we can start becoming outright bearish on this market, which is not the likely scenario, but it would have to take in a very significant sell-off that wipes through all of the support lines below, and the bulls simply don't defend any of that selling. At this stage, there's no evidence that we're going to be going through that, but if the earnings during earnings season in any way are come out negative compared to where everyone's expectations are, then we certainly can't rule any scenario out. Just to review our key points, our thesis since January 2008 has been that we're in a secular bear market. We don't change this thesis very often, but if this consolidation sideways, if not higher, continues to happen, then we'll certainly be more than likely seeing a market rally towards the year end, and if under those circumstances we would change our technical stance to a bullish one for the remainder of the year. like we were observing, we have completed a measured move on the upside towards the 1150 area last week, and so the market remains positive, but recognize that that profit-taking cycle could very naturally happen off these levels. These are now what we call technically completed measured moves. So there's at this stage the room for there to be profit-taking, especially if given a real reason to begin that. But what we're going to be watching for is that if the bulls can keep defending the support lines during any of these profit-taking cycles, then the market will start focusing on the year highs as an upside target, and we could potentially see that 1200, 1250 area on the upside within a reasonable period of time if again the profit-taking cycles are defended. So investors can cautiously start committing their capital to the markets, but again, the best time to do that is during consolidations that find good support. Next year, I want to take a look at the NASDAQ 100 using that E-mini futures contract. At this juncture, we had a very robust rally on the upside right up into the year highs up in that 2030 to 2060 area. This is really where the profit-taking cycle had to come from, and it is very unlikely that overhead resistance like that would be beaten on a straight line without there first being some sort of a consolidation. But again, we were looking for the profit-taking cycle to be contained somewhere above the 1910 to 1930 area. Right now, we're already completing the minimum retracement requirements around this 1980 area. Nothing stopping us from getting down another even 40 points lower into just a nice flagging wedge formation backwards in a profit-taking cycle. But so long as that is held and all the support lines are defended by the bulls, that would actually just be the market taking a break before another attempted push higher. Next year, I want to take a look at the U.S. dollar index futures, and this is really what's been driving so many of the intermarket relationships, is the fact that the weakness in the U.S. dollar has become predominant. When we failed to rally above that 83.50 area in August, the U.S. dollar basically reversed and began a very distinct downtrend, which has now come down towards our 77 to 78 downside target. This dollar index has almost finished its measured move lower at this juncture from what we're watching for. So at some juncture, the dollar index will at least retrace back toward the 79.80 area on the upside, and if it does that, then we'll probably see a little bit of profit taking in both oil and gold. So what we're watching to see how much longer the dollar index can remain weak like this before we have that snapback rally. Next year, I want to take a look at gold futures, and just like the dollar index is hitting its downside targets, gold is now almost complete all of its upside targets. Really, our boxed zone for the profit-taking area for gold was around this 1300 to 1340 area on the upside. So the fact that we've gotten basically up to the 1320 area, there may be even another $10, $20 more on the upside. But if that dollar index bounces, then gold will be given the reason to begin a healthy profit-taking cycle. Understand that even though there is maybe a little bit more upside, when gold goes through any one of its profit-taking cycles, in many cases it can wipe out as much as even $50 an ounce in a day. So while we're holding up here, we could find ourselves at 1280 or even 1270 in just one day if that profit-taking cycle is given a catalyst. And so at this stage, we would recommend anyone long gold to be locking in their gold either with protective puts, collar strategies, or even just taking money off the table and stepping to the sideline on gold. And it doesn't mean that gold won't be going higher, or that once that profit-taking cycle commences. But at this stage, if you're sitting on these really nice profits, you probably don't want to be giving them back during one of these profit-taking cycles. Next year, I want to take a look at crude oil using that E-mini crude oil contract. We were talking about that 77, 78 overhead resistance where the last swing occurred. We were saying that if that dollar index made that downside break, and oil would be given a catalyst to make that push higher. And so we marked off that any break above that 78 level would see us very quickly work our way back up toward that 81, 83 overhead resistance. These are where the previous highs all came in during the summer. So we expect there to be a little bit of resistance up at this higher zone. But if we do definitely have a bounce in the dollar index, we should see profit taking even all the way back down to 78 on crude oil. So it was sort of one to consider that we're at the top end of a trade range in crude. Next year, I want to look at the 10-year Treasury notes, and more or less here, we're in a situation where the Treasury notes are about to break to, again, another year high. And as they do, we're going to see historical lows on those 10-year Treasury notes. If we see this technical break and those lower yields, it's going to hit the media very quickly. And when we see that out there, that may, in fact, be something that spurs on the first wave of profit taking in the markets, as there would be concerns as to why the 10-year Treasury notes yields are so low, and why Treasury bonds continue to rally when supposedly the markets are out of the woods. So it's very interesting to see what happens here. The best case scenario for the bulls is that we see a double top on this 126 and a half focal point up above, and we see it work its way all the way back down to the previous low around the 123 area. If we saw that kind of price action in here, then that may start indicating that the 10-year Treasury notes are following a topping formation. And if we saw that, then that would certainly spur on a year-end rally. So the way that these 10-year Treasury notes play out will have an impact on the overall market. That was your Monday Futures Market Outlook. Thank you for joining me.